Hi everyone, it's Osman and Mustafa and Jed here today. We're just going to talk a little bit about the nature of angel investing, syndication, and what makes a startup venture backable. And this conversation originally kicked off from a comment that Jed actually made on one of our live streams about what makes a startup venture backable. Now, Jed's been around in this space for quite a long time. So welcome, Jed. Just quick introduction to the people listening.
Nice to meet you all. Nice to see all of you. Thanks for having me, Osman and Mustafa. Super quick intro about myself. Former tech operator. The last venture I was building was an API marketplace. We were backed by Andreessen Horowitz. I'm a self-taught angel investor, so I've never worked professionally in VC. Please don't hold that against me. In spite of that, we're sitting on an exit and I've backed two companies at seed stage that have turned unicorn at this point with a potential IPO next year. I started building my own angel network in 2020. And in the last 4 years, we've grown that to 1,300 LPs. We've written as large as single seven-figure checks into startups. And I'm the founder of angelschool.vc. We're an accelerator. We teach a few programs helping angel investors navigate the world of venture. And we also help experienced angels build and grow syndicates. That's my quick plug. Thanks.
That's awesome. I'm sure you must have learned so much along the way. And learning things by being self-taught is probably the best way, because you learn by trial and error. You learn by what works and what doesn't work. That's amazing. Thank you. Thank you so much for being with us today.
Thanks, Mustafa. I will say that, yes, you are right. But there's something very fundamentally messed up with the world of venture, especially for angel investors, right? The analogy, and I call it the poker analogy. It's basically there's a pay-to-play problem, right? For most angel investors, the path to learning venture is like going to a casino, buying real chips with real money, and learning poker on the fly. And so it's one of those issues that makes the cost of entry so high, right? And so yeah, I think. Well, yes, it's the best way to learn lessons. It's also at risk of personal capital. And so we take that really, really seriously. I think in a lot of ways, the stakes are higher for angel investors versus VC funds.
Yeah, I can totally understand. So I think the first angel investment that I made, and Usman and I went in on that together, maybe it was about 6 years ago, 7 years ago, maybe. And I didn't know much about the space at that time, but really paid to learn at that point. Yeah, it pretty much went south in that one. But and I feel like having known now all the stuff that I've learned over the years in the space, would have probably not made that investment.
That's all right. We all have a few scars, don't we?
Yeah, and I think if we don't have the scars, then really we haven't been doing this long enough. And I think generally, if you come across people who are other angel investors or who are syndicate leads, or even VC fund managers, they'll tell you about the things that have gone wrong, and all of that builds up into being both credible in your own head around what you're trying to do and being able to understand what types of questions you need to be asking above the normal type of questions that you'd expect from doing any kind of investment.
For sure. Yeah.
Yeah.
Can I build on that point? Is that okay?
Yeah.
I was gonna say, like, the skill of learning to be an investor is very, very hard one, right? What we're discussing. And so, philosophically, I'm trying not to make this sound like a plug for what we do. The way we wanted to solve the education piece or is to de-risk skills acquisition, which is why we had this structure whereby you do a formal program and a pedagogy, which is like really, really good. But you finish that, and then we invite the investors to be part of our investment committee. And Oz, you'll know about this because you've been in a fair number of these. mechanic there is, what if we could help people with skills acquisition on with zero expectations? So people get into this at the right time when they're ready and not before that, right? I think this like drives down the cost of failure.
Yeah, I mean, and just to touch on that, we've had, I mean, I get a lot of people who call me up and ask me, is it worthwhile joining Angel School? Personally speaking, I think it is. So this isn't a plug for you. It's just genuinely that's how I felt when I went through the program. I felt that there were a number of things which I didn't know, and what you just don't know what you don't know. But there were things which I didn't know. But it's also the approach that you take, which was very different to what I would do. And so a lot of the feedback I give to people is expect there to be a lot of due diligence and don't expect a deal to be happening every week. You'll find that you're going to be rejecting a lot of deals because of the criteria that you set. And as long as you stick
And
to
you
it,
should be.
yeah, you should, absolutely, right? I mean, there are quite a lot of angel investors or new angel investors who think that, all right, I've got some money, let me just chuck it at the wall.
Let her rip. Yeah, let's go.
Yeah, like black or red, let's do it. And
Yeah.
Yeah.
I really like the fact that you've built real structure around it. And I think for those who are just like wheeling and dealing, it can be a little bit frustrating for them, but it builds that level of maturity in being able to look at the startup, look at what they're doing, really ask the questions that matter, and then go through and going through the kind of the investment committee process as well gives you the exposure and the muscle memory to be able to handle that.
Yeah, I mean, I really appreciate you saying that, but let's give Mustafa a chance to say something nice about me too. I'm kidding. I'm kidding. No, but
go ahead.
I'm joking.
I've been holding it
no, yeah, exactly. I'm kidding.
No, I have to say that. No, I have to say that the session I attended. So you had a 3-part session recently,
Yeah,
right?
yeah.
And that was really really nice. Like I learned a lot in that. Even though I haven't caught up on one of the sessions yet, still the content I've viewed so far, I've learned a lot from that. And yeah, thank you so much for doing what you do. And it's teaching a lot. It's teaching us, who are new to the space and who are still trying to connect the dots. Really appreciate it. That brings me to a question.
Yeah.
What do you look at, like, when you speak to like early stage startups, when you think about like incorporating them into your you build a syndicate on them and stuff? What's your filter like?
Yeah, I think one of the elegant parts of how we operate and what we do is that with enough scale, we basically have this live sandbox for experimentation and development, right? So like all of this stuff that we do in like live deals, we pipe it back into programs. It just elevates everyone when they join the IC. That's kind of like one flywheel. Where we're at today is when we look at deals, we've got a generalizable framework, and there's like 7 or 8 things that we look at in diligence, right? It's none of this is like really rocket science. We're just making it really explicit and process driven. So what is the business? What the hell do you do? How do you make money? What is the market? Show me the traction. And we just kind of like run down this list. It's no different, I think, from a pilot having a checklist before you take off, right? It's just going through all of these things, and it imposes a rigor on it. Because to an earlier point that we were talking about, when people, angel investors are starting out, they get excited about a company, and then like you chuck everything out the window. We kind of like fall in love with it, right? I think like I'm amazing.
Yeah, we develop our own bias somewhere, right? Yeah.
Exactly, and we're trying to get people from away from that, right? Because like that instinctive kind of gut feel investing, it's just gonna come bite you. So we can talk about the details of what we look for, but I'll speak about one specific topic, which is market sizing. Okay, so market sizing is just one of those things that I think, generally speaking, everyone does it like ferociously badly. Founders obviously have an incentive to be like, oh, the market size is like trillions of dollars. It's the whole GDP of like Peru and Ecuador kind of thing, right? It's just, it doesn't make sense.
Yeah.
And on the other side of it, I think investors are really lazy about it. Right? And we don't have the capacity to or the budget to do primary research, but it doesn't help you to do desktop research and find corroborating data points. Right? But doing market sizing properly, like defining it properly and sizing properly, it basically determines like the upper limit of like where this company can grow, right? So to the original point of our conversation, is something venture backable? You know, for me, it's like, okay, we like market sizing because we want to know, like, realistically, how big can this be? And then there's a whole follow-on discussion we can have about Southeast Asia, right? The implications of that for this region.
Interesting, right? And it's interesting to see how, like, considering like the definition of, you know, what makes a venture-backed company, and that can vary depending on which part of the world you're in, right? If you're in the US, probably that criteria looks a bit different. If you're in, even if you're in Asia, if you're in Malaysia versus you're in Bangladesh or Pakistan, that looks very different. So it's interesting to learn these things along the way.
Yeah, for sure. I mean, look, in the region, I know you guys have a connection to like South Asia, which are really interesting markets, right? Because they're just like big. If you look at the rest of the world, you sort of know where the trajectory of where things are going. So maybe there's a path. And these are markets where you could build potentially, or my filter for Asia is like, how do you, whatever you're doing, can this be $100 million top line business? It's really hard to do that in like Singapore. It's just such a physically small market. But you look at Pakistan, Bangladesh, where there's so much opportunity, maybe it is, but then how does politics and currency and all of these other risks weigh in?
Yeah. I mean, and that goes back to a particular point that we've been dealing with a syndicate that we did for a startup in India, and it's just been really difficult, really difficult getting money into the country. Never mind getting it out. Most investors are talking about, well, how do I get the money out?
Yeah, let's get it in first, you know.
Yeah, let's get it in first, and then we can deal with that particular problem. But again, these are the scars that we pick up as well, and these are the things which I've been actively sharing as well on some of the investment committee discussions that we've had, Jed, where I've explained this is what's happened, this is what went wrong, these are the things you need to watch out for. And so the people on the investment committee are picking up on these as well and using that as part of their qualification criteria. But yeah, I mean, most of the South Asian and Southeast Asian startups that we typically talk to are usually domiciled in Singapore, and there are very rare occasions where we end up like looking at something which is domiciled in one of those frontier markets where you're only going to be successful if you are in that country, or you've got a particular inroad in there. That's why you see lots of VCs setting up specific funds in the particular country to avoid this whole issue around getting money in, getting money out. They can just use it with the local market. There's a whole bunch of stuff that we've learned from some of that. And I probably reflect back on the fact that even though we went through the whole Angel School program, these are the type of things that are just such an outlier that you're never going to learn until you actually try it. And then the whole idea of giving back is to share that war story with people and let them learn.
Yeah, I absolutely agree. I think the overarching mission is, how do we as an industry be better at codifying and transferring knowledge? You know, because until you do that, then everybody's got to reinvent the damn wheel every time, and it's so painful.
Yeah. Yeah. Hmm.
Yeah, I mean, and all of these things that we've been working on specifically, they all add real value to everybody within the community, and hopefully all ships rise with the tide and take something out of it. But yeah, I mean, both me and Mustafa met one of the co-founders of the startup that we've invested in one of these frontier markets. And going back to your point, Jed, could this business get to 100 million top line revenue? I mean, they're already there in terms of GMV, and they're on that trajectory. And when we were saying, we by default, it was just muscle memory. Which other markets are you looking at? And his reaction was, well, this market that I'm in is big enough to get me to $1 billion, no problem. And he was absolutely right. And so sometimes understanding those markets and understanding where they can get to, and hopefully they can give you a real potential for a moonshot, and it can be life changing if you do it right.
For sure.
Yeah.
Yeah, I think that. Yeah, I think that you're absolutely right about how do you like develop specific market expertise at scale, right? You made earlier around VC funds setting up shop in specific market because you gotta be on the ground to know these things, right? Like what businesses work and like can they become venture scale?
Yeah.
Like in the same way, and I don't know, this is the great experiment for us, is that can we be better at that decision making through the investment committee, right? Because it's like, Osman, right? South Asia, and we got a bunch of people in Bangkok and a couple of people in Malaysia, and we're almost playing a statistical game, right? It's like Moneyball here. It's like we get a deal who knows something about it, right? Either the market or somebody, right? And actually, it turns out like so far it kind of works out pretty well. It's kind of an interesting way to approach it.
Yeah, I mean, and that's a good point, because I have those moments where we're on a call, we're on the investment call, and we're talking, and there's an opportunity that we're looking at, and it might be really, really out there, and we don't know anything about it, and then somebody pipes up in the corner going, "Oh, actually, this is the industry that I've come from, and let me just tell you, these are the things." And within 3 minutes, they've given you a complete breakdown of that entire industry.
It saved you 3 months, right?
Yeah, absolutely. And it's that type of thing where you get off the call and you think, I didn't even know that. That was amazing. And yeah, it saved me 3 months of messing around when I could have just qualified it out through, like we did with that one person on the call.
Yeah, exactly. That's kind of like what the structure is designed to do. And like there are days when it works where I feel like I'm a genius, and other days where nothing's working, and also it's like, all right, we got to build some more.
That's awesome. That's like having your own expert network on speed dial.
Yeah, kind of. I mean, think about the idea of this, right? The core question is, if you want to give yourself every advantage in venture, or the way I think about it, it's like you play the statistics, right? And like, so what are your levers that you have to pull? One is, how much capital can you swing, right? And here we're about building the investor network and like just scaling that. Then it's about scaling deal sourcing. Well, if we build a community and people are like piping deal flow from us, and they're also savvy investors, then it raises the bar. Then it's about like decision making, and how do you do that across the world, different domains, different company stages, different markets. These are all human capital problems, right? It's not a technology problem. And then like I've met some people who are like, oh, GPT is great, I use them to write my investment memos. I'm like, you're nuts. It's like this is crazy. Like you don't find the state of the art there, right? I'm not saying it doesn't have a use, but this is not where you're going to make smart decisions, I think.
That brings me to 2 burning questions that I wrote down earlier. And I think both of you would like these questions. What are the hardest parts of like running syndicates, and what are some of the challenges around post syndicate liquidity?
Oz, you want to go first?
I mean, the hardest part, I think, of running a syndicate. Okay, let me take a step back first and say everybody thinks it's going to be a walk in the park, right? And they'll go, I know 10 people and they've all got money. You know, that's usually what people are thinking. And I've literally had this where people said, oh, look, I can run my own syndicate. Thank you very much. I know enough people. These are my connections and thank you. Thank you. But I think it's a comment you made, Jed. It's like it's not so much knowing the people, it's being able to unlock that potential in terms of being able to credibly have a conversation about syndicates, being credible about understanding venture and being able to understand the nature of the startup. I mean, we've got people who, like that I know, who are literally going in and talking to founders and saying, "Oh, look, I'll introduce you to 5, 10 people, and you give me some sweat equity." I mean, and for me as an investor, if I see just random people on a cap table, it's a real question mark about the credibility of a founder, and so there are a whole bunch of things that really become quite difficult in terms of running a syndicate. One is, I think the main one is really around being able to validate and get the deal funnel, being able to qualify it correctly, and then being able to credibly present that to an audience. Because if you don't have the audience and people don't think you're credible, well, you could have the best investment memo in the world, and like no one's going to believe you, right? So I think that,
And it's also the social capital on the
yeah, it's your social capital, absolutely, and I think that for me is the hard part. I think I'll leave the second question for now and let Jed have his view as well.
Yeah, let me just get on my soapbox here, guys. I here's what I would respond. Like, what's hard about building and operating a syndicate? I equivocate this process to running a bootstrap startup. Right? If you think about syndicates, what they are good for is this is about building yourself an equity engine, not a cash engine. So you need to scale, and you also need to be hyper efficient with how you spend, because it's very easy to let the cost run out of pocket and you don't have ongoing management fees, and it's easy to burn a hole in your pocket, right? Because you won't see a return in the long term. The other part of the equation, I think, is like, how do you scale this? The people that go, hey, I can find my 5 or 10 investors and they've got money, I can get a deal done. And you could, sure. But think about it this way. If every single one of those investors write the same check, you basically have a 10 to 20% capital dependency on any single one person. And it's a huge problem. When it works, it's great. When it doesn't work, you have a huge problem, which is why we're always like, okay, how do you build for scale? Because once you do, it's law of large numbers, right? I have 1,300 top of funnel. We push a deal out. If we do a good job, we get 20% engagement. So that's 260 leads that we nurture into a check, right? So you can play the number that way. And so in a lot of ways, when the syndicates and where people go, I want to find the ultra rich guy that can write me a 6-figure check. Sure. But there is a risk to that as well, right? Which is like the dependency part. And so my to what's the difficult part is managing the cost and the economics, and then also managing the scale, right? But the scale that's a good problem to have.
Interesting. I'm curious to know what the conversion rate is like, right? So let's say you speak to 10 angels, 20 angels, 50 angels. What percentage of them would typically make it all the way through and write that check?
Yeah. I'll tell you what my benchmarks are for these metrics. when you meet a potential investor and you're saying like, I have a syndicate and I have deal flow, I just want to share that with you. If you're targeting and profiling people the right way, pitching them the right way, and then doing resistance handling the right way, you should be converting at 80+%.
Shit, that's really good.
Then,
Good job, it's an adult platform.
then the next step is you find a deal and you push it out to the network. At 100-ish investor scale, right? So this is minimum critical mass for a syndicate. You should be hitting 22% deal engagement. So some expression of interest from 22% of those LPs. And out of that, we tend to see about 28-30% conversion into a check. So the last variable you're missing is what is your average check size? You kind of like asked a simple question. I gave you a really complicated answer.
No, it's good. I'm learning a lot. Thank you.
Yeah, I mean,
So
and
let's
there isn't. It's not a straightforward answer as well to running a syndicate. I mean, even just the first one took so much energy, and this was like, let me give this a go. And I remember like going through this program with Jed and thinking, yeah, I'm ready. And the amount of effort to prepare and to get everything right and get everything done, and you just think, how are we going to do this like on a regular basis as well? I mean, it becomes really quite taxing if you don't have the capability to scale it.
I mean, to be fair though, deal number one is the hardest. Now that you've gotten one over the finish line and with a very nice 6-figure win, I'm not gonna like say the number. It gets easier from here. You know you can get it done. And as you grow your network, those check sizes get bigger, right? And then the upside value compounds. So it's, it's just like gravy from here in a way, so.
Yeah, no, and I think for me, the hardest part was actually for the second and third one, it was just trying to make sure that I don't spread myself too thin and making sure that I'm constantly building that network of potentially interested investors, because you can't just keep on going back to the same people either. They may have different interests. This might have been the third deal. Number one may have been of an interest to them because of market, particularly the industry vertical, for whatever reason. And deal number two, deal number three might not tick that box. So going back to what you said, Jed, I mean, it really is important to have like a diverse network of investors who are interested. And yeah, some will hit, some will miss.
Yeah. I think you're in a really interesting position, actually, Osman. Now that you've got the first deal out the door, I mean, your LP network is, I mean, like, just what's the top of funnel for you right now, if you don't mind sharing?
I would probably say about 50, 60. Yeah. It's still pretty small, and it, if it was gonna keep me awake at night, that would be it. It was just really around being able to kind of build that database of people that are interested, because there are a lot of people who do actually say, "Oh, I'm interested," and actually they're not. They want to see the deal, but they are not prepared. I mean, like, even to write a $1,000 check, it's like a big step for them, and that's fine. But yeah, it's trying to sift through those as well, where people say they're interested, and in actual fact, this is not the type of investment that they really should be doing anyway.
I think like the interesting inflection point that you're going to pick up on is if you get to around 80-ish up to 100 LPs, when you start doing your next deal, you should start getting inklings of like referral effects, right? If like the deal is like driving new introductions to your LP, like just filling up your top of funnel, but in this case, they're going all the way down to the deal level, right? That's like the core mechanic that I use today, right? And so our investor acquisition is actually 100% inbound. Like, so theoretically, it just scales on its own without having to pay attention. But it sounds like there's a little bit more building to do, but a bit more numbers, I think you start to get real uplift.
Yeah.
So you're saying eventually you end up with these sort of your super fans, your heavy users, and then where you're like, okay, they'll come in with you on a lot of deals.
Correct. Exactly. Or basically what if you think about that funnel, right? It's like, okay, there's a deal and who's engaged and then who writes a check. The people who are writing checks, they are far more likely to be referrals because they're psychologically like bought in on the deal. And so in a way, when they tell their friends, they're not talking about your syndicate. They're saying like, hey, Osman's got a great deal. You should take a look at this. And so instantly, Osman has credibility. That person knows Osman has a syndicate. And then they're like, show me the deal. And so it's really powerful because you're just one step away from that commitment, right? And it's really small, which is why you need the numbers. But once you get that scale and then you see that happening, it's freaking magic, guys.
Cool.
Very nice.
And
we're up to about 31 minutes, but I have one more question. So let's say, after you finish these deals and you've built a nice syndicate, it's a done deal with a bow on top. What happens after that? Do you like go out and actively engage like VCs or other investors to talk to like maybe down the road purchase that, or is that typically something that's done by the founder of that startup? What does that post syndicate journey look like?
For me, and I think this is more a philosophical answer than a right or wrong answer. Everything for me comes back to like due diligence, right? We want to pick great companies because if the companies we pick are great, they grow quickly. It in a way opens up the liquidity path, right? It opens up the exit path or the secondary liquidity path. Anything else that you can do to like talk to other VCs? Hey, Mr. VC, I've got a mediocre company. Do you want to like buy me out? It's like that conversation is just not gonna fly. And so we don't try to focus on that too much. In the end, you gotta pick the right companies. If they do, that problem works itself out. Like we have had secondary offers for our positions in Turing.com, and then it's presented, you at least get presented as a choice as a syndicate lead. Do you want to accept this offer? Is this attractive enough that I would present it to my LPs and take, and make a recommendation? That's my take.
Cool. Thank you for sharing.
Sure. Osman?
Yeah. No, I mean, again, for me, in my own mind, I'm already thinking that most of the LPs that we talk to in our syndicates are looking at, the potential of significant multiples in it. And if you're getting in at the pre-seed or seed stage, pre-series A, then, realistically, I'm only going to be considering an exit when you get to a Series B or a very significant Series A. So if I was to kind of like say, this is the kind of little hill that I want to die on, then that would probably be it. But the kind of drawbacks I see to waiting through to IPO is that, IPOs are great and they're fantastic, but then you also have a holding period to actually sell your shares, and that can also be an impact in terms of you've got a whole bunch of LPs that are kind of yapping at your heels saying, why can't we? And part of me doesn't want to have to deal with that. Kind of just say, like, can we wait 6 months or 9 months? These are the terms of the deal that, we've gone to IPO and now we've got to watch the share price go up and then potentially go back down. And while that's happening, you've got like 20, 30 people like messaging you every day going, have you exited yet? Have you sold? And you're like, and I've never had to experience that. I just know that that's the type of thing that would drive me to, drive me insane.
Yeah.
And so I think I'd be looking at a secondary exit, like a Series B, Series C, somebody wanted to take a larger equity stake in the company, and then I'd be like, okay, LPs, take a vote. What do you think? This is my recommendation, and then see which way the wind blows, and then go with that.
There are benefits to also taking an earlier liquidity, right? It's just people are happy when they get money back. It's going to help you establish your track record. They're probably going to tell their friends, I did this deal with Osman, I got my money back, and I made some money, and there is a strategy to it. But what I wanted to build on in terms of like looking for liquidity and exits is that it's a very tricky market, right? Venture markets are highly inefficient. All these people that want to say, oh, we have valuation techniques and blah, blah, blah. It's like, okay, so we were so technical. How did we go from 47 billion to zero? Like, how many orders of magnitude is that? You know what I mean? The simple truth is that hype and sentiment drives a lot of this, right? It's all capital. If you look at secondary market, it's a very interesting space. I'm actually doing a keynote at Web Summit this year in Lisbon, and they were like, "Oh, let's do this one." I gave them a bunch of stuff, and they want to talk about this. What we're seeing with secondary markets is that it's a very bifurcated scenario. When things are going well, like in a venture boom, you'll see that the median deal transacts on secondary markets at roughly on par value to the last price round, right? So if you did a Series C, it was $200 million. You seek a secondary exit at the Series C, it tends to trade at that value sometime later when you try to get a sale. But when the markets tank, and this is the situation that we're in, the trough of secondary market transactions, we saw deals trade at 50% discount to the last price round.
Wow. Yeah.
Okay, so think about that. You invested, and then you're trying to get an exit. You got to take a 50% haircut 18 months later to get liquidity. And so it's not as easy as saying, I want an exit, I want to take money on the table. But the small market, the low transaction, the fact that these tend to be quite institutional buyers, they're all sharp, right? They're looking for the best deals, and all the offers that we've gotten for Turing.com, they're okay, but it's the same pattern. They were like, we'll offer par value to the last price round, and so that's the best deal that you're going to get on a great company. So I don't think, I mean, it's a very hard thing to explain to LPs, but the reality is it's just not that easy. Ergo, go back to picking great companies and make sure that LPs know they got to be prepared to let it ride.
Yeah. I mean, and that's kind of the frustration that you sometimes get when people are wanting, they've invested like 3 months ago and they're saying, when's the exit? And you're like, oh.
Yeah, how long can you hold your breath, pal?
I know, right? I mean, okay, we did talk about this being a long game, and 3 months is not long. Yeah, and we have that. We get that sometimes with people.
It is a perpetual tension. You can have the conversation, but it is still going to come up. Like I said, bootstrap startup, you got to do IR work as well.
And angel investing is high risk, right? So it reminds me of the saying in crypto, right, where if you're in it for the Lambos, you're also in it for the ramen. So yeah, it's just high risk, right? So it could do really well, or it could go south, right? So
yes, yeah. Which also means that I think like angels, just like everyone, need to be focused on returns. Sometimes there's this narrative like, oh, angels don't need the same returns as like VCs. I'm like, bullshit. Like that money is going in earlier stage and riskier, and you're saying it's okay. You don't need the higher returns. Like how do you justify that?
Yeah, I know. I mean, the sense of entitlement that you get from people who say that as well, it's kind of galling. Yeah. Anyway, I mean, we're literally hitting up to the 40-minute mark. So much for trying to keep this to 15 minutes. And I don't know if we've got any closing comments, because I think we should really wrap it up. But yeah, Mustafa, any closing comments?
No, just wanted to say, Jed, thank you so much. I learned so much, from watching your videos, from reading your content. Thank you for doing what you're doing, and thank you for being with us today. Yeah, just look forward to engaging with you more. And yeah, that's it for me.
Well, thanks for having me, guys. I appreciate the opportunity, and thanks for having me.
All right, cool. I mean, I've really enjoyed this conversation, and I think anybody watching, just to be really clear, we've gone completely unscripted. We haven't really done a script where we would like make this kind of a stale kind of conversation.
Yeah.
Everything that you've heard
If we
today
seem
is literally
unorganized, we are.
I know, right?
We even used words we shouldn't have used.
Yeah. Thanks. Anyway, so I'm going to end the stream now. We've hit the 41-minute mark, and thanks everyone for tuning in. And I'm kind of hoping that you enjoy it if you're playing this on the replay. Thank you.
Thank you. Good night, everyone.
Thank you.
Bye. Bye.